If gold is able to hold on here in this above 1900 this week and in the next week, that low is going to strengthen. People are going to come in. They're going to move their bids up. They're going to stay in there. They're going to say, yep, 1900 is good. I'm happy buying it. And then that just sets up the next attempt at a new all-time high. And I like gold and I own it. Like, it's not hard. I believe in tangible assets. I believe it also as a kind of philosophy in a portfolio sense. You've got your savings, gold. You've got your industry, your going concerns. Animal husbandry is a metaphor for buying, large caps or whatever it is that you think are viable businesses, and then your guns are what you use to protect your wealth with, right?
Gold was little changed on Monday as investors awaited U.S. inflation data that could influence the Federal Reserve's policy stance. According to renowned analyst Tom Luongo, if gold remains above $1,900 per ounce this week and the following week, it will gain strength and attract more buyers. Luongo believes in investing in tangible assets like gold, considering them valuable and secure. The June meeting marked the first reprieve in the Fed's campaign to address stubborn inflation after it reached a multi-decade high last year. Fed Chair Jerome Powell has justified the pause by stating that the effects of earlier rate hikes still need time to fully impact the economy, along with the drag on hiring and growth caused by turmoil among regional banks earlier this year. Federal Reserve officials signaled their intention to resume interest rate increases due to a growing consensus that further tightening is necessary to combat high inflation in the world's largest economy. However, Luongo commends Jerome Powell for raising interest rates, believing that this move is necessary to prevent negative consequences associated with persistently low rates. The Federal Reserve is likely to raise its benchmark interest rate later this month to a range of 5.25% to 5.5%. Even though there is a slightly lower chance of any further increase after a government report showed hiring slowed more than expected in June. Higher interest rates dull the appeal of gold, which pays no interest. Traders now see about a 20% chance of a rate hike in September and a 40% chance of one by November, following what is almost universally expected to be a quarter-point increase at the U.S. Central Bank's late July meeting. In a recent interview, Luongo predicted that the U.S. dollar would enter a bear market while gold would experience a positive trend. A stronger U.S. dollar tends to keep the price of gold lower and more controlled, while a weaker U.S. dollar is likely to drive the price of gold higher due to increased demand. Now let's watch excerpts from Tom Luongo's interview with SOAR Financially. Before we start, smash that subscribe button and remember to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
We're on the verge of a credit crunch, right? And that's been engineered quite brilliantly, I think, by Jay Powell over at the Federal Reserve. It's what I begged him to do and hoped he would do as a doctrinaire, not even doctrinaire at this point, as an Austro-libertarian, whatever you want. It's like, dude, zero bound interest rates are bad for everybody, except the people who want to enslave you and who want to hyper financialize and leverage everything up to the gills in order to extend and pretend bad ideas that should have been liquidated by the market ages ago, right? And that's what zero bound interest rates are all about. That's all they really are at the end of the day. And Powell has now raised rates very aggressively. He's probably, I'm not sure that, I'm on the fence as to whether he'll do so again in July. But if he raises in July, he won't raise in September. Because we'll get into the quality of that labor data you were just talking about. In essence, what I've been saying for just over 2 years now is that Powell started stealth tightening in June of 2021 when he raised the reverse repo payout rate 5 basis points above the Fed funds rate, which immediately began draining the world of dollars. We drained $2 trillion into the reverse repo facility. We drained the markets of euro dollars. The euro bull market collapsed overnight. And then everything held since then has been kind of a rearguard action on the zero bound negative bound regime of the rest of the world that propagated because of the Fed being at the zero bound all these years and the central banks all coordinating their behavior. That ended that day. And then I looked at it and I'm like, could Powell actually be tightening here? Could Powell actually be getting set up to do what I would expect him, what I would hope he would do, not expect him to do. What I expected, like everybody else, was for him to, like Puxatawny Phil, see his shadow at the first sign of trouble and then run back into his hole and go, nope, 6 more years of zero bound interest rates, right? But that's not what happened. What happened was he wound up in a 6 month long protracted political fight for his reconfirmation. Well, he had to stand there and go, "Oh, I think inflation's transitory." Meanwhile, he's been sucking liquidity out of the global markets the entire time. And then once the inflation story caught up to what was actually happening on his front, right, and he built this massive war chest of money, dollars, on the reverse repo facility, and he still has the $5.5 trillion worth of treasury sitting on his balance sheet, thanks to Bernanke and Yellen's ruinous policy. Once his reconfirmation was paved, once the path of his reconfirmation was paved, and Biden eventually had to knuckle under and give it to him, he started raising interest rates 2 weeks later. And at that point, I said, well, if he's doing that and he really wants to change monetary policy, the dollar's been in a bear market since last October, been in a bear market correction since October. So gold is obviously going to run. The Bank of Japan let up on yield curve control in December, right? There's been a run in the euro. Oil prices are down. The 3-year yield is rising. You know what? That makes sense that gold would be under pressure. That's okay.
Absolutely.
It's on sale. That's the way I look at it. I'm like, ooh, I will be honest. I bought gold on Sunday night.
Nice.
Not a lot, or last week. I bought it last week. It just got delivered to me the other day. I bought a little bit of gold. Not a lot, a few $1,000. Why? Because I had it, waited for the price to correct, 8, 9%, 1,900 looks good. Hey, I'll buy some.
Moving forward, Luongo stresses that there was a deliberate effort to bring down certain banks without causing a widespread banking crisis. He emphasizes that some regional banks in the United States have significant financial problems and may fail, but they will have a small global impact. Luongo points out that the responsibility for managing the risks associated with banks has shifted to the European Central Bank and the City of London, reducing the control of the United States over its markets. This shift in the banking system is essential for the United States to have more control and autonomy over its currency and debt. The previous system was designed to serve the interests of external entities rather than benefiting the American people. Central bank leaders like Jerome Powell are working towards establishing greater control and independence for the United States, even though they may not explicitly state it. This shift in the banking system will likely impact the global economy significantly, and Luongo believes it will be interesting to see how it plays out in future years. Let's get back to the interview.
There was a definite whiff of intentionality in taking down the banks that were taken down. And we never saw it spread. Now, do I think there are a lot of regional banks in the United States that have big gaping holes in their balance sheets? Yeah. Do I think some more of them are going to fail? Yes. Do I think it's going to be a big global contagion effect? No. Certainly not if what will happen first and what may continue to happen is, again, it's all the onus is now on the ECB. All of the rate risk has been transferred to Europe, to transfer to the City of London, and they no longer have control over our markets anymore because our markets are regulated by SOFR, not LIBOR. Yeah. And that is everything you need. It's 2 days after the Declaration of Independence Day, right? The July 4th, the United States banking system or monetary system just finally, after 200 and some odd, 50 years, finally declared independence from the Bank of England. And this is a big, big deal. And I can't stress this enough. And so when you put that together, now you can start to see how we can have an independent treasury market, not independent, but much more. We are the price makers, no longer the price takers for the value of our own currency and our own debt anymore. This is insane. It was insane that it was ever like that. And when you stop to think about the plumbing and the architecture of our own monetary system, no American that likes America would ever put that together. Clearly, this was put together by people who have a vested interest of utilizing America's massive built up industrial and capital wealth for their purposes. And that's what's going away here. That is what is the subtext for all of these market moves. And once you see that, If you see it that way, and I can convince you to see it that way, even if you don't believe me, even if you don't agree with me, look at it that way and then tell me where I'm wrong. Because it's very clear when you listen to Powell talk, when you listen to Lagarde talk, when you listen to Ueda over at the Bank of Japan talk, it's very clear that that's what they're working on. Powell won't say it directly. He uses inflation as a cover story, which is why if inflation drops over the next two prints, he may not raise. He may give the markets a break. He may give those regional banks another 6 weeks, 8 weeks to do some repair on their balance sheets, to roll out some of their duration risk, allow some of the worst of their assets, figure out, find ways to sell them off or restructure them or whatever they need to do. Give them some time to absorb what he's already done while he continues to do QT in the background and shrink the balance sheet by $95 billion a month. And mostly that will be treasuries from, at this point, not mortgage-backed securities, because he needs to exit the treasury market in case there is a shock in the future.
Federal Reserve is expected to raise interest rates in July, which could weaken the U.S. dollar and make gold more attractive to investors. However, there are also some risks to the gold market. If the U.S. economy grows more vigorously, it could lead to higher interest rates and a stronger dollar, which would pressure gold prices. What are your thoughts on the Federal Reserve's plans to raise interest rates? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.